Hello, everyone. Today on the Final Bar, we're joined by Patrick Ceresna, joining us from Toronto for Big Picture Trading. We're going to talk about the pullback in some of those key mega cap tech, consumer communication services names. The big question for investors this week, among many weeks, is really what differentiates a garden variety pullback with stocks pulling back to reasonable, viable levels versus something deeper. We had a bit of relief earlier today, reaction to the Fed meeting, but stocks resolving lower with the S&P finishing down about 0.5%. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Good afternoon, and welcome to today's version of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at these markets together through the lenses of behavioral finance, technical analysis, trying to focus on the overarching investor psychology, ways we can anticipate trends, follow the trends, and look for potential momentum shifts. Today, Fed Day, all eyes on the Fed, and, the initial reaction, my take as I'm reading it did not feel like any huge surprises, sort of felt like more of the same. The market rallied pretty quickly right at the conclusion of the meeting, and it felt like we were going to get a resumption of this recovery period. By the end of the day, though, if there were not question marks on the recovery, you may have, got it just from the short-term read as things reversed just as quickly when went lower to finish really at the lows of the day with the S&P down 0.5%. We've talked about the breadth conditions. We've talked about leadership rotation. I think today with energy leading, with technology to the upside, technology leading to the downside, really speaks to a continuation of that rotation away from the stuff that got us here into other things. And the question is that enough to propel the market to further highs from here? Now, we have some wonderful guests on the show. It's one of my favorite parts, being able to chat with some really knowledgeable, thoughtful analysts, traders, strategists. Today, we have Patrick Ceresna joining us from Big Picture Trading and the Market Huddle podcast. So excited to hear Patrick's take. Tomorrow, we have David Auerbach from the Daily REIT Beat, talking a little more about income investing. REITs have been a surprise outperformer, I think, from my perspective. So interesting to hear his take. Next week, we have Tim Brackett on the 22nd. He's from the Markets Compass. And then on Wednesday, the 23rd, Leslie Juflas from here in the Seattle area joining us. Our next major event is coming up in less than a week. On September 22nd, we are doing an event called Introducing StockCharts ACP. Producer Gretchen has done a fantastic job lining up a lot of moving parts to put together a fantastic event for all of you, highlighting the ACP platform. This is our new advanced charting platform, a dynamic, fluid, integrated charting platform as part of everything you already know on StockCharts.com. We have talked in the last couple of weeks to people like John Murphy, Martin Pring, Arthur Hill, Larry Williams, Dave Landry, Mish Schneider, so many fantastic, Ralph Eckenpour, fantastic, knowledgeable, smart people that have been doing this for longer than I have. And it's been fantastic getting their take on the evolution of technical analysis. And a number of them have created plugins that you're going to be able to see potentially for the first time at our event. So that's coming up on September 22nd. Check it out, Introducing StockCharts ACP. As we think about the market recap, let's go through some of the changes. And again, as always, I have told my children, if you really want to make life exciting, try to host a closing bell show, because things whip around a lot right now going into the close. And just when I feel like the show will have one vibe, the vibe changes in an hour, and all of a sudden we go from making new highs for the day to making new lows for the day. The S&P finishing lower by about 0.5%. The S&P down around 33.85. So certainly the bounce that we had out of the Fed meeting was one move. But again, there's a difference between the Fed announcement and then the Fed, Powell's comments on the press conference. Looking at the chart again, I'm a chart guy, so I try to draw my conclusions as much as possible further just from the chart and not from any other big picture thinking. But I can't help but notice the market was doing really well until Powell started making comments, and then we sort of turned lower very quickly. So certainly what people were hoping to hear or expecting to hear, they were underwhelmed by that, and the S&P finishing lower. The NASDAQ really was the story in terms of, parts of the market moving up or down, with the XLK down 1.5% plus, and the same with the NASDAQ 100. Mid caps and small caps actually finished today a little stronger. Again, they all gave back whatever gains they had going into around 2:30 p.m. Eastern, but still finishing stronger on the day. So outperformance from small caps so far today. Looking at other markets, the bond markets came off pretty good in the afternoon session, with the TLT finishing down about 0.3%, really sort of chopped around through most of the afternoon, and 10-year yields a little bit higher, up to around 69 basis points. Oil, pretty good out of the gates, and finished up over 4% for the USO. The GLD and silver, sort of the precious metal trade, essentially finished flat. Gold finished a little bit stronger. They were up earlier in the day, but finished up just sort of minimal to the upside. Looking at a daily chart of the S&P, again, I'd hesitate to draw too many conclusions from one trading day, especially if you're a longer-term investor. But it's all about what the price does relative to key barometers, key lines in the sand. And, for us, as we've talked about, until proven otherwise, a trend is in place, right? As long as we're making higher highs and higher lows, the trend is in place, which means we are looking for two things right now on the chart of the S&P 500, a lower low and a lower high. And those two things would then tell us that, at least on that tactical time frame, the trend is now lower. We haven't quite seen it yet. And I would say over the last week and a half, every time the S&P has attempted to close below 3350, which would push it really below the first couple weeks in August, it's been repelled. It's come back up to the upside. The last couple of days have closed lower than the open. Certainly today felt like a little heavier than what we've seen in the last couple of days. And again, I think we're still looking at 3350, and the 50-day moving average is just below that, around 3335. And I think the S&P's ability to hold that level will be key. If it starts breaking down through that, all of a sudden you will see a new low, and you will also have established a lower high from the last week and a half. And so we're very close to confirming sort of that short-term downtrend, but not there yet. And again, I think that's one of the great benefits of using charts in this sort of situation. You don't have to guess whether the market's going up or down. You look at the trend and define it, and that's what you're looking for. So a break there would be key. I would expect us to break that. I would expect us to go to 3,200. That's where I have thought ahead and thinking this is where that's really the line, the ultimate line in the sand for stocks. We're able to hold those July swing lows after the breakout in June. If so, I think it's all about rotation. If we break that, I think you need to start looking further to the left and further down for potential risk management, and thinking about stops that have not been triggered and where you'd want to make sure that those are in. But again, now is the time to be looking at downside projections, what potential outcomes would be, and what you would do in those scenarios. It's not, as things are selling off, that is not the time to develop your exit strategy. That's essentially like the plane, the engine cutting out, and you're losing altitude very quickly, and then you decide to start looking for an airport. Let's reverse that plan just a little bit. Looking elsewhere at rotations, again, it's sort of that late cyclical trade. Energy, industrials at the top of the list today. Energy, really the big gainer with stronger oil prices. The XLE up 4% today. Financials number two, and we've talked about the relative strength of financials. While there are some compelling charts coming out of there, as a sector, it's not been the best relative play. But overall, again, a sequence of days where it's more at the top of the list, there may be some patterns emerging you want to pay attention to. I would say an overarching, takeaway from my work over the last week or two is that as a stock picker, there are plenty of opportunities. There are stocks making new highs, even though the S&P is unable to do so. And there are times when the market is doing one thing and stocks are kind of all doing the similar thing and going up. And there are times when the market craters and everything seems to sell off. This is one of those times, because of the dominance of mega caps and this rotation away from some of the big names that got us here. I could see a situation where the indexes do one thing, but your experience as an equity investor may be very different depending on what particular stocks you own. So more than ever, I think it's important to look at stocks that are able to produce consistent positive returns. Things like FCX, FDX are names that we've looked at just recently, able to continue to move to higher highs and higher lows, while other charts are unable to do so. And those are the things I would certainly want to be looking at. We've talked about airlines, and again, I'm a skeptical strategist looking at things like airlines just because of how beaten down they've been. but I can't help but notice charts like Delta Airlines. And again, not all of them look like this. There's a little bit of a dispersion within airlines. It's not all one chart right now. There are times when they tend to trade similar. Here we're actually seeing some different movements. So things like American Airlines, others are sort of stuck in no man's land. Things like Delta are starting to emerge, but the charts of airlines remind me a lot of the charts of financials. They're struggling to get above their June highs. They have not been able to really get above their 200-day moving averages. Overbought right now as it approaches previous highs. So my base case is you see something like this is approaching pretty good overhead resistance, and you'd expect a bit of a pullback on these things. But seeing financials, seeing airlines, others in industrials, able to break above those levels, that would certainly make the charts feel a lot more constructive than we've seen up until this point. Just to wrap up our overall review of what's happening in terms of particular groups, half of the top 10 industries together today, all within energy, and that was really the story in terms of breakouts. So E&P stocks, pipeline names, integrated. So these are the big names like Exxon and Chevron up at the top. Airlines, as I mentioned, and home construction, which would be the home builders, up in the top 10 as well. In terms of groups going lower, again, it's always interesting to know what is the broad market doing, what industries, what sectors are agreeing and disagreeing. Worth noting some of these. We don't have time to go through too much of these, but some of the big groups like computer hardware, like software, like internet, these are the sectors that have things like Microsoft and Apple, big names that you probably don't want to be going down significantly, all leading the way lower. And certainly as we come out of our commercial break, we'll hear from Patrick Ceresna, hear his take on some of these mega cap names that have gotten us to this point. We'll take a quick break. Back with Patrick Ceresna. See you in a minute. Hello, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. We love to hear from you, feedback on the show, feedback on our guests, but most importantly, questions that you're running into as you try to apply the tools we discuss in a real-life environment, managing your own analysis, your own perspective, your own position. So shoot us your questions on anything related to the markets, charts, technical analysis, whatever it is. The Final Bar at StockCharts.com is our email. On Twitter at FinalBarSCTV. You can get us there, or on any of our YouTube videos, just put a comment right below the video. We'll bring all those together and hopefully answer one of your questions in our next mailbag segment at the end of this week. I want to bring on my guest, Patrick Ceresna. Patrick's coming to us from Toronto. He's at Big Picture Trading, also co-host of the Market Huddle podcast, which I'd certainly recommend. Really, really well done in terms of commenting on the broad market environment. Patrick, welcome to the show.
Well, thank you for having me, Dave.
So as we talked earlier in the show, I think, investors are sort of dealing with this potential binary outcome. Is this a buyable pullback before a resumption of further upside, or is this the beginning of something deeper? We're starting with your chart of the NASDAQ 100. Give us your take on this chart, and what does that mean for the big picture environment for you?
All right. Well, first thing I just want to touch on, which is not on this chart, is just putting context on global equity, because really global equity has not performed remotely to the degree of which the NASDAQ has. And really, you can narrow down to about 10 or so stocks that have disproportionately contributed to almost all the major performance in the US equity markets. And so one of the things that I was always arguing is that either A, when we see the blow off of the major NASDAQ stocks that have been the leadership along the way, that will mark some sort of a top, or we would need to see a major asset rotation where the rest of the market can pick up the slack from these tech companies. And so we saw this going into the stock split of Apple and Tesla, this froth that was really developing in the markets, and it led to a real kind of buy rumor, sell news event triggered around there that really began some selling on the downside. And what we saw right across, whether it's the S&P 500, the NASDAQ, and so many of these other markets, everything pulled back in about 3 days, right down to its 50-day moving average, which technically is where dips are often bought. You know, you talk about what usually is an arbiter of trend. You know, you can use higher highs, higher lows, but a lot of times one of the simplest things to do is simply ask, is it above its 50-day moving average? And so we tested it, and we were expecting a bounce, and we got a bounce, but so far the bounce has been pretty pathetic, to use it no other way to put it. And so the big question, normally you would see a relatively reflexive rally that is of equal magnitude to the decline in terms of its velocity. It's sort of like a bungee cord jumping. And so I would have already anticipated the NASDAQ to have been back to 11.5, 11.8 on the upside, and we're no sign of it. But when you go through all of the FANG stocks through it, let's just go to the next one, Facebook. Where's the rally? It's still along its multi-day lows. Go to the next one on Apple, right along its week lows. Go to the Amazon, right along its week lows. Go to Microsoft, right? Not all the way down there, but it's below its 50-day, not far from those lows. Just has not been able to muster up a rally. Then you go to Google. Right along those weak lows. The point is there hasn't been a bounce in any of these leadership stocks. And the thing is that now we see the reaction on the Fed brought about a kind of first reaction up, but then led in the selling. If we don't see by the end of the week the bulls put together something meaningful, then the selling's not over, and we probably have one more leg lower in the correction. And even if things get ugly, it could get worse. But I mean, right now the base case is that we're going to get into a deeper correction by next week if this is all the bulls can muster up.
You know, it's some great charts that illustrate the lack of demand that's come in as some of these major names have pulled back a little bit. Yeah. So the argument some have made is this is not a market top. This is more of a rotation, right? So these big names got us here. We're now rotating away from those and into things like industrials, materials, even financials that are starting to emerge. What for you would differentiate between sort of just a leadership rotation, a change of, you know, who's in the driver's seat versus more of a full-fledged selling? Is it particular levels that would be broken, or is it more relative performance? Like, what would answer that question for you?
Well, first of all, a correction is different than a liquidity event crash, right? And
Sure.
during a liquidity event crash, like we saw during March, the correlation of all assets go to 1 and they drop. The thing is that there's definitely going to be asset rotation, but these mega caps are so big that it's going to be hard to hold the indices up if they're selling. And so there will be definitely safe haven places to rotate money into. But I think the indices are going to just be dragged down like an anchor with these big boys.
It makes a ton of sense, Patrick. We only have about 30 seconds left, and I'd love to know, so given your overall base case, which sounds like a little bit of a deeper correction, sounds like this might be the beginning of something a little further on, unless we see some signs of life going through the end of the week. Where would you be looking if you had to be going into equities right now? Are there any particular groups or any particular sectors that you think starts to emerge as a good opportunity? How would you answer that?
You talked about the fact that the energies broke out today. I thought oil was a buy on dip on the commodity front, and so these energy stocks may get some tailwind, and that's a value sector that might get rotation. But a lot of the inflation-driven trades, a lot of the miners, not just gold, but like you're talking about copper and a lot of the basic material names, all are holding up very, very well. Maybe some of those areas will get some buying, even in spite of this weakness in these mega caps.
It's a great take and some wonderful charts and some really, really good points. Patrick Ceresna, thank you so much for joining us. Wish you and your family well, and look forward to talking to you again soon. All right.
Thanks a lot, Dave.
That's Patrick Ceresna joining us from Toronto. You can find him at Big Picture Trading. He's also the co-host of the Market Huddle podcast, which is one of the things that I have on my list to listen to anytime I can. I encourage you to check out Patrick's work there. Our next segment is called, it's actually a new one called Compare and Contrast. One of the things that we were talking about, Gretchen, my producer, and I were talking about just different, angles to approach things. What are the tells that we could look at to try to frame things out? We talked about breadth plenty. We've talked about sentiment regularly. One thing that I tend to lean into are ratios, which is basically comparing and contrasting two different asset classes. And some of that is similar to just a pure relative strength read. So for example, one of the things we look at often on the show is the relative performance of semiconductors. But what I wanted to do is actually look at my ratio chart list and sort of dig into some of these comparative themes, because as Patrick and I were just talking about, if this is a leadership rotation, which it's undeniable that there's been a rotation away from tech and into other places, some of those, inflation sensitive spots. What, how can you sort of understand that rotation? What can we use to visually represent that rotation and whether or not it continues to play out? I have a ratio chart list. And again, most, if not all, the charts that I show here are all part of the morning coffee routine chart pack. If you go to your dashboard, go to your chart list, there's a little button that says manage chart packs, and you'll see something like David Keller's morning coffee routine or something like that. I encourage you to set that up on your StockCharts login. You can access pretty much everything we look at here, including this ratio chart list, which shows the relationship between different assets. We're going to start and see how many we can get through before we need to wrap the show. The first one is a ratio we've looked at in some different ways, and this is the way I've traditionally looked at offense versus defense within consumer. There was a chart in the Fidelity chart room years ago, and one of my mentors, Bill Doan, who ran the group in the 70s, early 80s, we talked about, sort of how he thought about it, and I forget what the ratio is actually called, but it was using an outdated data set that wasn't around anymore, so we ended up using this as a proxy for his offense versus defense ratio, which he'd followed for decades. And so this is simply the ratio of the XLY to the XLP. If it's going up, it's favoring offense; going down, it's favoring defense. And this has been, sort of in an uptrend pretty consistently since the March lows, since a little before the March lows. That's arguably could be driven by Amazon, Home Depot. The two of those stocks are, a huge, that's almost 35-40% of the XLY. It's just those two names. Amazon on its own is 25+%. So an equal weighted version of that ratio is here at the bottom. You can see this is making a new swing high and is broken above the June high. So this takes the overweight of Amazon out of the picture and focuses more on the movements of the individual names, an equal weighted assessment of all of the stocks that make up the two sectors. You can see that that's clearly favoring consumer discretionary as well. So in terms of consumer, investors are leaning more on offense than on defense through this week. The relative performance of semiconductors we've talked about a lot. And again, my base case for this is as a broad economic indicator, just like you might have looked at transports and industrials years and years ago if you're Charles Dow. I would argue we need to look more at what really is driving economic growth now. And semiconductors are a pretty decent way because it pretty much runs most things I'm using working from home right now. And so the performance of semiconductors not just tells you about the strength of the companies, but it's people's expectations for the stock and for the stocks. And if they start to roll over, if the relative strength suffers, I think that would speak to expectations coming off a little bit. And what we've seen in the last 6 weeks is overall the ratio has gone from an uptrend to a bit of a downtrend, and seeing if this ratio continues to make lower highs, lower lows, remains below its 50-day moving average, that would tell me a bit of internal weakness there. We've talked about financials emerging, and again, as much as we've seen some rotation away from tech, I think it's worth noting the long-term outperformance of tech is still pretty staggering by any measure, even giving away some of that in the last couple of weeks. So this is the ratio of the XLF versus the XLK. It has been going down and to the right for quite a while. This is the last year, and you can see just the last week or two is this little blip, which is within the context of this huge run of underperformance. So I think, announcing the end of the tech trade and the emergence of financials, we are nowhere near me being comfortable making that sort of proclamation, especially when you look at this chart. This is looking at a much longer term history, and you can see the financials have been underperforming tech on a broad basis since 2006. Now that's with notable changes with, 2009. And 2013, you had some, 6-12-month runs where it certainly felt like there was a change there. But overall, you have never really been paid to own financials over technology since the 2000 to 2002 run. And maybe you can extend that to the 2007 market high. But since then, you've really not been paid to own financials over technology. And again, the little outperformance we've seen is this little rounding error on that ratio. So I think there's a lot to be proven before you feel like you want to lean into something like that relative to something like tech. Another way we can look at the performance of technology and how it is overweighted and how it relates to other things is looking at this ratio, the Qs versus the diamonds. This is very similar to looking at the relative performance of the XLK, to be totally honest with you. It's a similar read, but you can see that this ratio is once again below its 50-day moving average, potentially making a lower high. And again, this ratio turning lower, really breaking through the low from early August, would tell me that we're really seeing, I think that would potentially coincide with a much deeper sell-off in the broader averages, because it's basically saying people are going into the relative safety of the Dow members as opposed to the tech-heavy NASDAQ. Here we're looking at the XLY versus the XLK, and just looking at the relationship between those two, you can see that this ratio has gotten above its 200-day moving average for the first time in the last over a year. We can see that it's still essentially been range-bound. If you look at this relative performance for the last 6 months, those two sectors, XLY and XLK, have essentially been a wash. They've been relatively similar to one another, but it's just testing the upper end of this range. And the question is this a cyclical pattern that reverts lower, or is this the beginning of emergence of consumer over technology, which would be very different? From here, we look at a lot of different ratios. The performance of momentum as a bucket, and this is essentially owning names that have done well. We're in a leadership rotation, which means this ratio is chopping around a good amount because the things that have gotten us here are starting to falter a little bit. And so the names that actually make up that momentum ETF are in flux right now. So I have to see how that evolves. Small caps versus large caps, as much as we think of this as being a very narrow-led market, which I would say overall, there's no doubt on the dominance of mega caps, but it's worth noting that the ratio of small versus large in terms of the IWM versus the SPY has essentially been flat. If you go back to this is the March low here, you have the rally into the June high from about late May to where we're at now. That ratio has gone nowhere, meaning there are fits and spurts, but most of those gains came out of this period when small caps really started to outperform. Since then, they've been basically even as they've all kind of come up together. And again, the question now is, do small caps continue to outperform this little blip that we've seen? Is that the beginning of something more? Do people go into the safety of mega caps and this ratio starts to turn lower? And a stronger dollar, the dollar has been incredibly weak. Does a stronger dollar do something to impact this ratio as well? Those are all questions I would want to answer using that chart. That's all we can get through today. This is a ratios chart list that I use. And again, it's all built on comparing different parts of the equity universe to other parts. There are more charts in that list to review. And I encourage you to check it out on your own and hopefully make it part of your normal routine. We need to wrap the show, go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is one of my favorite long-term charts. Anytime someone talks about financials being a good idea for some reason on a relative basis, I usually throw this chart at them, which is just bear in mind you are fighting 10 plus years of a downtrend here, really going back to the 2007 high. And again, I'm zooming way out, and there are periods here where owning financials over technology certainly would have been a good short-term play looking 3 to 6 months out. So that's 100% understood. But remember, as a long-term investor, there just hasn't been a benefit to owning financials over technology for a long time. So as much as we think about a return of financials, remember, that's all relatively short-term relative to the long-term trends in those two particular sectors. Chart number 2 and the next two are looking at individual names, and they're not saying these are particular ones that you need to be taking action on. But I think in terms of your overall market awareness, one of the things we talked about, really maybe the theme of today, was this rotation, right? This leadership rotation, what it means and how the broad indexes may sell off. And that might be a reflection of the leadership rotation and less the, overall everything going down. And I think I would point out on a day like today, you had charts like MCD, McDonald's, which are now above their February highs. And they've had this nice rally in the last couple of weeks while the markets have sort of come off a little bit. Here's a stock within the consumer space that's actually continued to do very well, making new 6-month relative highs potentially this week, price making new highs above 2 upward sloping moving averages. So, and then the chart number 2 here is Coca-Cola within consumer staples. As a sector, consumer staples certainly not as attractive as consumer discretionary if you look at the ratios we talked about earlier today. But there are charts like this that rallied out of the March lows, that had a consistent resistance level, broke above it, broke above the 200-day, tested it from above, resolved back to the upside. And overall, if I had a portfolio of charts that looked kind of like this, I probably wouldn't feel that bad about the overall potential. So my point with those two charts is not that those are the two examples of all of them, but just to show that there are stocks out there in favorable positions. Now is the time to be screening and thinking about which charts to lean into and which charts to lean away from, regardless of the overall market environment. Folks, that is our show for today. Thank you so much for joining us on a Wednesday afternoon. A special thank you to Patrick Ceresna joining us from Toronto, Big Picture Trading, giving us his take on this leadership rotation away from some of those mega cap names. As a reminder, get your questions in the final bar at StockCharts.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.